An exchange traded fund or ETF is an investment fund that trades like a stock. ETFs, like other types of funds, pull money from investors into a basket of different investments, including stocks, bonds, and other securities. By spreading the fund's money into different securities, ETFs can generally provide investors with diversification and with a balanced risk. And because ETF shares are traded on the stock exchange, they are bought and sold like stocks and usually incur commissions and other related fees. Just like there are a variety of mutual funds, there are a variety of different ETFs, each with different objectives. Some replicate the performance of a stock index like the Dow Jones Industrial Average or the S&P 500, and others track performance of a particular sector like technology or pharmaceuticals. However, different ETFs offer different amount of diversification. For example, ETFs that focus on a specific sector offer less diversification than those designed to replicate an index. Suppose an investor wants to make a diversified investment that is designed to mirror the performance of a major stock index like the S&P 500. After researching different ETFs and finding the one he wants based on its objective, he purchases shares of it through his broker, just like he would do for an individual stock. Now that he has his own shares, the investor has a stake in each of the fund's basket of investments, while only having to purchase one ETF. Participating in the wide market with only a single purchase instead of multiple purchases can save an investor research and analysis time. Similar to a stock, he can earn a return in two ways. If our investor purchased a hypothetical ETF of $40 and a year later it was selling for $50, our investor could profit $10 per share by selling his position. Of course, if the ETF price dropped, our investor would have lost money if the position was sold at a lower price. Because many ETFs are traded on the stock exchange, they can be bought and sold throughout the day. However, not all ETFs are widely traded, which can cause difficulty when trying to fill orders. Now, compare this to a mutual fund. Most mutual funds are priced and traded at the end of each day. Separate from changes in price, our investor could potentially gain income if the ETF pays the investor a dividend, which is a payout of the fund's earnings or capital gains. Now, not all ETFs pays dividends. Many instead reinvest earnings into the fund's holdings. One way to tell whether the fund pays dividends is to look at what is called the dividend yield. This yield is the amount that the fund pays out compared to the current market price of a share. ETFs have other attractive qualities. While most mutual funds require a minimum investment which can be substantial, an ETF investor can buy a single share plus any commission and fees. Also, because most ETFs aren't actively managed, they typically have lower management fees than mutual funds. There is a wide variety of ETFs that attempt to track assets like corporate bonds, stocks in remote countries, commodities, and even currencies among other investments. While these assets carry a unique risk, the ETFs that track them offers investors a practical way to analyze and potentially find opportunities in other markets. One of the great benefits of investing in an ETF versus a stock is that when you purchase a single stock, if that company goes bankrupt, then you potentially lose your money if you didn't sell on time. While if that company goes bankrupt in the ETF, then that will be replaced by another progressive company, and then it will continue to push the ETF price higher. So that's one great advantage of ETF versus investing in individual stocks. Some common ETFs are VOOO, VGT, VTI, and VUG. Now that you have the basics on ETFs, you can use websites like ETF.com to find more ETFs, and then you do your own analysis and decide which one of them you want to invest in. Thanks for watching. See you in the next one.